Okay, let's dive in. Welcome, everyone, to a deep dive.
Yep, we're here to unpack the sources you've given us.
Exactly. Our mission is simple. Take your stack of materials, articles, reports, whatever you've got, and pull out the absolute must-know insights.
We sift through it all so you'd get the core knowledge, the surprising bits, basically everything you need to get up to speed quickly.
Think of it as your shortcut. It's all based entirely on the information you shared.
We're just guiding you through what seems most important in these documents, highlighting those key takeaways.
Right. So today, we're hitting two main areas based on your sources. First, the big economic picture, global and U.S. macro environment for 2025 and 2026.
And then we zoom in, a detailed look at specific companies you flagged in the technology and cybersecurity space.
It's all about seeing how that big picture might connect to these individual players, all through the lens of your docs.
Let's jump right in then, that economic backdrop first.
Yeah, let's start there. The forecast for 25-26, what are the sources saying globally?
Okay, globally, things look like they're slowing down. The projection is for growth around 2.9% in 2025,
Okay.
and then dipping just a tiny bit more, 2.8% in 2026.
So down from the 3.3% they saw in 2024, that's a noticeable deceleration.
Definitely. And the main culprits cited are, well, persistent U.S. tariffs and just generally weaker global demand.
It really shows how trade policy ripples out, doesn't it? Real economic effects worldwide.
And what's really interesting here, according to these sources, is inflation. It's expected to diverge.
So,
Well, while many other countries might see inflation keep slowing down, the U.S. is flagged as a potential outlier.
an outlier, meaning
Yeah.
higher.
Potentially, yeah. The sources suggest U.S. prices could actually peak again, maybe hitting 3 to 3.5% in Q3 2025.
And is that linked back to the tariffs you mentioned?
Directly. That's the connection made in the documents. Tariffs mean higher import costs passed on to consumers.
Right. So if inflation pictures are diverging, what does that mean for central banks? Are they all doing the same thing?
Not quite. With slowing growth elsewhere, there's a general lean towards cutting interest rates globally.
Okay.
At the U.S. Federal Reserve, expected to be different. The sources indicate the Fed's likely to hold rates steady until at least March 2026.
March 2026, wow.
Yeah, and only maybe 2 rate cuts in total expected by mid-2026. They're targeting a Fed funds rate around 3.25–3.5%.
So the rest of the world possibly easing while the Fed stays cautious. That policy gap could definitely move markets, currency, capital flows.
For sure. And your sources also mention governments might try to step in. Increased spending expected in the U.S., Europe, China.
Try to prop up their economies.
Right. Stimulus. But the flip side is potentially higher public deficits, longer-term debt questions there.
Makes sense. And the overall tariff impact, is it seen as temporary?
Not really. The documents suggest the damage has already done significant global economic impact. And even if they were reversed, it might not fully bring back the old growth rate. And the risk of tariffs going up again, that's flagged as a serious risk. Could even potentially trigger a recession, according to this material.
Okay, quite the backdrop. Let's zoom in on the U.S. specifically then, based on the info from, May 2025?
Right. So for the U.S., the sources project pretty modest real GDP growth, just 1.3% for both 2025 and 2026.
Only 1.3%. And is that steady growth or?
Expected to slow down within that period, actually. The sources talk about approaching stall speeds.
Stall speed sounds slow.
It is like 0.6% year-over-year growth by the fourth quarter of 2025, so losing quite a bit of steam by year-end.
But despite that slowdown, the recession odds mentioned were actually lowered a bit, from 45% down to 35% for the next year.
They were lowered, yes. But the documents are very clear. Downside risks are still there. Definitely persist.
Okay. What about jobs? The labor market?
Looked pretty solid through April 2025. But the prediction is for momentum to downshift.
Another effect of that tariff shock mentioned.
Exactly. That's how it's framed. So payroll job gains are projected to slow right down through 2025.
How slow?
Potentially bottoming out at just 25,000 jobs added per month in Q4.
Oof. That's barely moving.
Yeah.
Indicates real strain.
Yeah. And on inflation, again, in the U.S., it was improving before those April tariffs hit. Headline CPI was 2.3% year-over-year in April.
But the tariffs reversed that trend.
Expected to.
Okay.
That's the forecast.
Let's hear it.
A renewed push upwards on inflation. Your sources revised the year-end CPI forecast up to around 3.3% year over year.
Before it cools off again later.
Yeah, eventually cooling back to maybe 2.2% by late 2026.
And that inflation forecast explains the Fed's caution we talked about, holding rates until at least September 2025.
Right. They're balancing trying to manage those potential tariff price spikes without crushing jobs in a slowing economy. It's a tricky spot.
And trade policy itself, still a big factor.
Huge. Even with some temporary 90-day tariff reduction mentioned on certain Chinese goods, the average U.S. tariff rate, still the highest since 1939, according to these sources. And the expectation is these tariffs keep dragging on consumer spending and business investment through the summer, at least.
Plus, you mentioned higher bond yields also playing a role, constraining investment.
Yep. Linked to concerns about tax legislation costs, another constraint on businesses.
Okay, so let's tie this macro piece together before we hit the companies. We've got slowing global and U.S. growth.
Right, tariffs causing unique U.S. inflation issues.
Cautious central banks, especially the Fed.
A cooling labor market predicted.
And constraints on investment. This isn't just background noise, is it?
Not at all. It's the critical stage. It's going to directly influence earnings, how consumers behave, market sentiment, even for these tech companies we're about to discuss.
Okay, great context. Let's pivot then. From the big economy to the specific companies in your documents, technology and cybersecurity.
Right. And the sources note this sector often shows resilience. Growth drivers like AI adoption, digital transformation.
But the catch
often comes with premium valuations. High prices relative to earnings, meaning high expectations are baked in, makes them sensitive.
Got it. First one up in your material, Okta, ticker OKTA. What's their core business?
They're a leader in identity management for businesses. Their Okta Identity Cloud platform basically handles secure connections.
Like employees logging into apps.
Exactly. That, plus helping companies manage customer logins smoothly, streamlining partner access, things like Universal Directory, lifecycle management, attack protection are mentioned.
Okay. And how have they been doing recently? Performance.
Looking at their fiscal Q1 2026, which ended April 30, 2025, revenue was $688 million. That's up 12% year over year.
Solid growth.
Yeah, subscription revenue also up 12%. But what's really telling for the future is RPO remaining performance obligations.
Right, the contracted future revenue.
Exactly. Their total RPO jumped 21% year over year to over $4 billion. The current portion, expected in the next 12 months, up 14%. Strong visibility there.
That's a good sign. And profitability.
Big improvement there. They actually shifted to GAAP operating income in Q1, $39 million versus a loss last year.
GAAP profitability, okay.
And non-GAAP operating income was robust, $184 million, a 27% margin. Plus, strong free cash flow, $238 million.
So generating actual cash. About 35% margin on that free cash flow.
Yep. It points to them getting more efficient, finding a clear path to sustained earnings.
What are the growth catalysts mentioned for Okta? Why are they growing?
Well, market leadership is key. They've got around 40% share in identity and access management, IAM, and keep 97% of their customers.
High retention. Sticky product.
Very sticky. High switching costs because they integrate with like over 10,000 applications. Plus, the whole IAM market has tailwinds, remote work, zero trust security, compliance rules. It's expected to grow 12% a year through 2030.
And are they getting more profitable as they grow?
Sources say yes. Margins expanding as they scale. Things like lower cloud costs, selling more to existing customers boost revenue per user. And they have a strong balance sheet. Lots of cash, no debt, flexibility.
Okay, sounds pretty positive. But there must be risks or headwinds mentioned.
There are. Despite the strong Q1, their guidance for Q2 and the full year was conservative.
How conservative?
Q2 revenue growth projected 13-14%, full year only 9-10%.
Why so cautious?
They specifically mentioned macroeconomic uncertainty and lingering effects from past stuff 2023 tariffs, a security incident they had.
Oh, right.
They also lowered their full year free cash flow margin guidance, down from that 35% in Q1 to around 27% for the year.
And how did the market take that?
Not well. Stock dropped. Highlights how sensitive these growth stocks are to guidance, especially with high valuations.
Speaking of valuation, what do the sources say? As of late May 2025.
Pretty high. Trailing PE was over 157. Forward PE, looking ahead, around 31. EBITDA was almost 72.
How does that compare to others?
Well, the sources mention app software average PE around 57, cybersecurity of EBITDA maybe 9 to 12.5 times. So Okta is trading at a significant premium.
Meaning the market expects a lot of future growth.
Exactly. High expectations priced in. Makes it vulnerable if they miss, especially after that guidance.
What about analysts? What's the consensus view?
Still buy overall based on 40 firms. Average 12-month price target around $123.65. That's like 17.5% upside from the price mentioned, $105.23.
But is it tight consensus?
No, the range is wide, $75 on the low end, $155 high end. But the overall support suggests belief in their long-term story, despite the near-term caution.
Okay, moving on. Palo Alto Networks, PANW. Big cybersecurity name.
Yep, known for firewalls, but increasingly cloud security, too. Big global presence, lots of Fortune 100 clients.
Recent performance. Fiscal Q3 2025.
Revenue hit $2.3 billion, up 15% year over year. GAAP net income was flat, but non-GAAP was up 20%.
And their shift to subscriptions, how's that going?
Going well. Strong growth in what they call NGS AR Next-Gen Security Annualized Recurring Revenue. That was up 34% to $5.1 billion. Total RPO also strong, up 19% to $13.5 billion.
So that move to recurring revenue is working, making things more predictable.
Definitely. Their big strategy is platformization, trying to be a one-stop shop for cybersecurity. Growth drivers are things like their Prisma Cloud Suite and AI and threat detection.
AI again.
Yep. And sources note 81% of revenue in Q2 came from subscriptions. They're also using AI internally, like for automating support, to boost margins.
What about the downsides?
Risks. Margin pressure from that cloud transition is one thing. Gross margins are apparently 5-7% lower than their old on-premise stuff.
Okay.
Disruption risk, too, from smaller, nimbler AI cybersecurity startups offering maybe lower-cost options. And macro spending cuts could hit their traditional firewall business, still 25% of revenue.
And valuation, elevated like Okta.
Yes. Quite elevated, according to the sources. Around 16 times price to sales, 2.2 times EVR as of May 2025. Significant premium.
Pricing in lots of future cloud and AI success.
Seems like it. Makes them sensitive to slowdowns or if they stumble on execution.
Analyst view on Palo Alto.
Very positive. Strong buy-by consensus from 49 firms. Average target $212.97, about 14.6% upside from $185.82.
Wide range again?
Yeah, $130 to $235. But strong confidence overall in their strategy, despite the high price tag and risks.
Okay. Next up is Cognate Software, CGNT. What's their niche?
They're in investigative analytics software, using AI to help clients, often government or security agencies, make sense of data quickly for investigations. Actionable intelligence is their term.
How's their performance looking? FY 2025 ended Jan 31st.
Full year revenue up 12% to $350.6 million. Q4 revenue up 13%. The key point here is they hit GAAP operating income in Q4. Small, $0.7 million, but positive, versus a loss before.
Another one turning the corner on profitability.
Exactly. Non-GAAP metrics also improved strongly in Q4. Operating cash flow for the full year was solid too, $46.8 million. It's a crucial step.
What's driving their growth? Catalysts.
Strategic acquisitions, like one called GroupSense, expanding their U.S. footprint, and a big push towards recurring revenue.
Subscriptions.
Yep. They highlight a big multi-year subscription deal over $10 a year with the security agency in EMEA. That shift, plus new AI solutions, boosts predictability, could lead to a re-rating of the stock if it continues.
What are the risks mentioned?
Well, EPS estimates for the next quarter, Q1 FY26, were basically zero, so significant profitability is still maybe a few quarters out. Also, they're a smaller company, smaller market cap, which usually means more stock volatility.
Valuation picture,
Yeah.
even they're just getting profitable.
Yeah, it's tricky. Price around $10.97 in late May. TTM EPS is barely positive, so PE is super high or undefined. Hard to compare directly to mature software peers. The bet is on sustained earnings growth leading to that potential re-rating.
Analyst take.
By consensus. But, interestingly, the average 12-month target in your sources is $10.
Below the current price.
Slightly below, yeah. Range is narrow, too, $10 to $10.76. Suggests limited immediate upside seen, even with a positive outlook. Cautious optimism seems to be the vibe, waiting for more proof of sustained profit and growth acceleration.
Okay, CrowdStrike next. CRWD, another big cybersecurity name. Endpoint security.
Right. AI-powered platform for endpoint security, threat intelligence, response across PCs, cloud, IoT, the works.
Performance. Fiscal Q4 2025 ended Jan 31st.
Strong revenue growth. $1.06 billion, up over 25% year over year.
Profitability.
Reported a GAAP net loss of about $92 million. EBITDA was -2, but cash flow was strong and positive. $282 million, up nearly 40% year over year.
Okay, so similar to Sentinel later maybe, generating cash despite GAAP losses due to heavy investment.
Exactly that pattern. Healthy model generating cash, even while investing heavily for growth.
What are their growth drivers?
Their AI platform is meeting strong demand. Annualized recurring revenue, ARR, was $920 million, up 27%. And over half their new bookings came from newer areas like cloud and AI security. Shows a successful strategic shift.
They have ambitious targets, too. Right?
Yeah, very. Mention of a $10 billion ARR target by fiscal 31. They're also phasing out some discount packages, which should help growth accelerate again.
Risks mentioned.
The sources briefly mention a competitor, Sentinel, seeing some ARR stagnation and disappointing guidance, perhaps as a general market caution point.
Okay, industry context. Any specific CrowdStrike risks?
High sales and marketing costs impacting margins typical for growth mode, and reliance on continued AI adoption and key partnerships.
Valuation, back in January 2025.
Reflects the growth story. Negative PE because of losses. Very high price-to-book ratio, over 34. Valuation isn't based on current profits. It's all about that huge revenue growth and future potential. High growth, high risk. Thesis relies on scaling up to profitability.
Analyst view.
Generally buy. Average target $433.26. Range $390 to $500. Positive sentiment despite the losses suggests confidence in their long-term AI platform story.
Got it. Let's switch gears slightly. A10 Networks, A10 Secure Application Solutions.
Yeah, helping enterprises protect their applications and networks. Things like application delivery controllers, threat protection systems.
How was their 2024? Fiscal year ended December 31st.
Revenue was $261.7 million. That was up from 2023, but actually down from 2022. So a bit mixed on the top line.
But profitability?
Improved. Net income was up significantly in 2024 compared to 2023, hitting $50.1 million, suggests better cost management, efficiency gains.
And more recently, Q1 FY25.
Sources mentioned they beat estimates, so some positive recent momentum operationally.
Growth catalyst is basically be in the right space, cybersecurity demand.
Pretty much. Aligning with that need for secure application delivery.
Risks mentioned.
Some technical indicators for the stock price looked bearish back in April 2025. Trading below key moving averages looked oversold.
Interesting. Technical weakness, despite fundamental improvement.
Yeah, that divergence suggests maybe broader market or sector pressures were weighing on the stock price, maybe separate from A10's own performance.
What about valuation? Late May 2025.
Price around $17.50. Forward PE looking ahead a year was about 24.8.
How does that stack up?
Appears relatively attractive compared to some industry averages mentioned, like communications equipment PE around 35. Suggests it might be undervalued if the profit trend holds and revenue stabilizes.
Analyst take.
Buy-hold consensus from the four firms covered. Average target is $22. That's significant upside, over 25% from the price noted. Range $20 to $24.
Any notable analyst actions?
One firm upgraded them from hold to strong buy. Reinforces that idea that maybe the fundamentals are stronger than the recent stock price suggested.
Okay, next is a giant. Broadcom. AVGO. Semiconductors and infrastructure software. Big AI player.
Huge AI player, according to your sources. Dominant in AI chips, networking hardware. Key enabler of the whole AI revolution.
Performance details.
Not full financials in these snippets, but they highlight incredibly high adjusted EBITDA margins.
Yeah.
Like 66% in Q2, 68% in Q1.
Wow, that's massive profitability, shows strong efficiency, pricing power.
Definitely seems so. Likely driven by demand for their specialized AI stuff.
Growth story is all AI then.
Pretty much the core engine. Dominance in crucial AI infrastructure components. They benefit from software recurring revenue too, and premium pricing on those AI chips.
Any specific tech mentioned?
Yeah. Third-gen co-packaged optics for high-speed data transfer and AI systems. Plus, a big $10 billion share buyback authorization signals confidence. And a potential partnership with Apple on custom AI server chips.
Huge potential there. Positions them for major long-term growth with AI.
Absolutely. Risk.
Potential tariff impact on their wireless business is mentioned about 16% of sales supplying Apple. But their AI and software segments are seen as buffering that.
And valuation. High.
Yes. PE of 41 mentioned, above their 3-year average of 30. Premium valuation suggests a lot of future growth is already expected, priced in. Sensitive to slowdowns. Specific numbers. Late May 2025.
Price $242.07, market cap over $1.1 trillion. That PE of 41 is a big premium versus typical semiconductor averages mentioned, like 12x or 29x. Clearly reflects the AI hype and expected growth. Analyst view on Broadcom, overwhelmingly bullish, like 94.6% BUY ratings, average target $268.56, about 14% upside from the price noted, range $170 to $275. Strong belief in the AI growth story.
Okay, let's talk Cisco, CSEO, networking and security leader.
Right, switches, routers, wireless security, collaboration, broad portfolio, global reach.
Recent performance, fiscal Q3 2025.
Strong showing in key strategic areas. Security revenue jumped 54% year over year, networking up 8%, total product orders up 20%.
What about AI? Are they playing there?
Big time. AI infrastructure orders blew past $600 million in Q3 alone. They actually beat their $1 billion annual target a quarter early.
So the AI pivot is working.
Seems like it. They also raised their full-year revenue and EPS guidance. Indicates confidence in that strategic shift.
What are the catalysts driving this?
Aggressive push into AI, expanded partnership with NVIDIA on AI data centers, launching new high-speed switches for AI cloud customers, infusing AI across their security and collaboration products.
And security growth.
Yeah, benefiting from demand for things like secure access, Hypershield, XDR, added over 370 new security customers.
Risks for Cisco.
Operating in that tough macro environment we discussed is one. The stock had apparently underperformed recently, suggesting maybe the market is weighing the transformation success against those external pressures.
Yeah.
And competition from nimbler cloud-native security players.
Valuation. Late May 2025.
Price $62.87. TTM/PE around 26. Price to sales just under 4. Solid profitability, good return on equity.
How does that compare?
Looks relatively attractive compared to some peers mentioned, like Com Equipment PE 35, especially for a large, profitable company with a clear security strategy.
Analyst consensus.
Strong buy from 22 firms. Average target $71.28, over 13% upside from the price noted. Range $63 to $79. Positive outlook despite recent stock lag, suggesting belief the strategy will pay off.
Oracle Next, or RCL. Database giant moving heavily into cloud.
Exactly. Big push into cloud infrastructure, Oracle Cloud, IaaS, and applications, SaaS.
How do they do in fiscal Q3 2025?
Total revenue up 6% year over year. Cloud services revenue up 10%. But the real star was cloud infrastructure, IaaS surged 49% year over year.
Wow, nearly 50% growth in IaaS.
Yeah, hitting $2.7 billion. Cloud applications, SaaS, also grew 9%. Strong operating margins too, but the headline number.
Let me guess, RPO.
Got it. Remaining performance obligations hit a massive $130 billion, up 62% year over year.
$130 billion. That's incredible future visibility, explains the cloud push.
Totally. They're planning to double data center capacity in 2025 due to record demand, and they're jumping hard onto the AI wave.
How so?
GPU usage on their cloud for AI training is way up. They're integrating models like ChatGPT, Grok, Llama directly with their Oracle database, partnering with all the big AI players, OpenAI, xAI, Meta, NVIDIA, AMD.
Positioning themselves as key AI infrastructure.
Exactly. Plus, their database, multi-cloud revenue selling Oracle DB on AWS, Azure GCP, surged 92%. They expect 15% overall revenue growth next year, driven by that huge backlog.
Sounds powerful. What are the risks or concerns?
Valuation looks high again. EBITDA mentioned around 21.9x versus industry average maybe 16.4x. Suggests a lot of this upside is priced in.
And the cost of building all those data centers.
Significant capex, $4 billion in Q2, projected to double in FY25, could strain near-term profits and free cash flow, even if necessary long-term.
Other risks.
They're still a distant third in the cloud infrastructure race behind AWS, Azure, GCP, and reliance on those multi-cloud partnerships means they aren't dominating alone.
Valuation summary. Late May 2025.
Price $164.76. That high EBITDA reflects the cloud AI excitement. Analysts have a strong buy consensus from 36 firms. Average target $178.48, about 9.5% upside.
Wide range again, I bet.
Very wide. $130 low, $246 high. Reflects the potential, but also those risks, capex, competition. Analysts advise a multi-year horizon and realistic expectations.
Qualcomm Next, QCOM, wireless tech, semiconductors, patents.
Yep, big in 5G. Fabless model, expanding into automotive, IoT, wearables.
Recent performance, fiscal Q2 2025 ended March 30th.
Look good on the surface. Revenue up almost 17% to nearly $11 billion. Net income, EPS, EBITDA, all up strongly year over year too.
Okay. I sense a but coming.
You sense correctly. However, the sources highlight a big issue: cash flow. Cash from operations was down significantly, over 28% year over year.
Where free cash flow
Declined substantially, down over 55% year over year.
Ouch. So profits look good on paper, but actual cash generation is weakening.
Exactly. That divergence is flagged as a critical concern in your material. Raises questions about the quality of earnings, funding future R&D, shareholder returns.
What are the growth catalysts apart from 5G leadership and patents?
Expanding into those new markets, IoT helps diversify away from just smartphones. And the fabless model gives flexibility.
Risks are mainly that cash flow issue then.
Primarily, yes. That's the big red flag raised. Plus, historical patent disputes and intense semiconductor competition. Your snippets didn't have specific analyst views for Qualcomm.
Okay, emphasis next, INFY. IT services, outsourcing model.
Right. Big offshore presence, lots of North American revenue, consulting, managed services, cloud, BPO.
Performance, fiscal year ended March 31st, 2025.
Full year sales were up over 6%, net profit up about 2%. However, yeah, Q4 sales saw a sequential decline compared to Q3, attributed partly to seasonality and some cost factors, but signals potential near-term pressure. They did declare a dividend.
Growth drivers for Infosys, AI mentioned.
Yes, actively pursuing AI-led transformations for clients, launch specific AI offerings like Infosys Topaz. Strategic acquisitions are also expanding their services, and focus on large deals for stability. Plus, strong free cash flow and high dividend payout.
Risks, macro uncertainty hitting them.
Seems so. Client spending caution, delayed decisions impacting growth. Tariffs, geopolitics add uncertainty. Acquisition costs could pressure margins. And that Q4 sequential dip highlights sensitivity if projects get delayed.
Valuation, late May 2025.
Price around $18.14, normalized PE about 24, price to sales under 4, strong ROE over 28%.
How does that look versus peers?
Appears relatively undervalued compared to IT consulting services averages mentioned. Might attract value investors given the ROE and dividend.
Analyst consensus.
Buy hold. Average target $19.63, only about 6.3% upside from the price noted. Modest upside suggests caution near term, but AI acquisitions offer a long-term story.
Palantir Technologies, PLTR, data analytics, government, and commercial clients.
Right. Platforms like Gotham and Foundry to integrate and analyze data for decision-making.
Performance, Q1 2025.
Very strong growth, especially in the U.S. Government revenue up over 40%. U.S. revenue overall up 52%. Commercial up over 30%. Secured lots of big deals.
Forecast looks strong, too.
Yeah, projecting robust growth for FY25, particularly in U.S. commercial revenue, up 54% forecast. Demand seems high.
Growth catalysts, AI and government demand.
Exactly, benefiting hugely from that. Strong U.S. commercial traction. Partnership with Bain & Co. for AI adoption. Big Army contract win, too.
Okay, sounds explosive. What's the catch? Valuation?
Bingo. Valuation is the major concern highlighted. PE ratio mentioned as being over 500.
500.
Yep. A DCF analysis mentioned in the sources apparently shows the stock price way above intrinsic value, suggests significant overvaluation.
Makes it highly speculative.
That's the word used by some observers in your sources. Also noted that international commercial growth lags, especially in Europe, which could limit expansion.
Valuation summary. Late May 2025.
Price $130.22. That PE over 500 is extremely high versus industry averages. Market is pricing in massive future growth. Highly sensitive to execution, very speculative profile.
Analyst view must reflect that valuation concern.
It does. Consensus is hold, and the average 12-month target is $70.72.
Wait, $70? That's way below the $130 price, a 46% decrease.
Exactly. Clear signal analysts are worried about the stretched valuation, even with the strong growth. Sentiment suggests the good news is already more than priced in.
Okay, Sentinel next. Ticker S. Another cybersecurity platform, AI-driven.
Yep. Autonomous platform using machine learning, behavioral AI for threat prevention, detection, response across endpoints, cloud IoT.
Performance. Fiscal Q1 2026 ended April 30th.
Revenue up nearly 23% to $229 million, still reporting net losses and negative EBITDA heavy investment phase.
But free cash flow.
Positive. $105 million, up over 28% year over year. So similar to CrowdStrike, robust growth, generating cash operationally despite GAAP losses.
Growth catalysts. AR growth strong.
Yeah, ARR hit $920 million, up 27%. And again, over half of new bookings from emerging cloud and AI solutions. Successful strategic shift. Focus aligns with evolving security needs.
Risks or headwinds mentioned for Sentinel loan.
Stagnation in net new ARR and initial FY26 guidance described as disappointing potential growth slowdown. Economic pressures delaying deals. Management apparently signaled needing to adjust growth retention expectations. Challenging for a high flyer.
Valuation, late May 2025.
Price, $17.58. Negative PE due to losses, negative returns on assets capital. Valuation is based purely on growth potential. High risk, high reward.
Analyst consensus.
Buy overall from 46 firms. Average target, $22.65. Optimism despite losses suggests belief in the long-term potential driven by ARR growth and the cloud AI shift.
Zscaler next. Cloud-delivered security. ZIA for external apps, ZPA for internal apps are their main suites.
Performance. Fiscal Q3 2025 ended April 30th.
Revenue up over 22.5% to $678 million. Small net loss, slightly negative EBITDA. Positive cash from operations up nearly 22%. However, always a however, with cash flow, it seems. Free cash flow.
Turned negative. Negative $36 million, down significantly year over year.
Okay, that's a concern. Investments outpacing cash generation.
That's flagged as a significant headwind, likely investing heavily in infrastructure, R&D, and it's currently more than the cash coming in from operations. Impacts near-term financial health.
Growth drivers. Zero trust. AI.
Yep, zero trust everywhere strategy. AI-powered initiatives like ZDX Advanced Plus are key differentiators driving recurring revenue, enhancing their core ZDA ZPA offerings, winning larger customer deals.
Risks, besides the negative free cash flow.
Facing profit pressures and delays in deal closures are mentioned, and valuation considered high, implying future growth is already baked in.
Valuation summary, April 2025.
Price, $276. Negative PE again. Very high price to book, over 21. Negative returns. Valuation driven entirely by future growth hopes. High growth, high risk profile. Depends on reaching scale and profit long term.
Analyst stake.
Sources mention increasing optimism, but the average 12-month target is $243.55, slight downside from the price noted, $254.07.
Interesting. Optimism, but a target below current price.
Yeah, suggests some caution. A hold rating from Mizuho is mentioned due to profit pressures deal delays. Wide range reflects varying confidence in them converting growth to profit and positive, FCF.
Okay, two more from the financial data services side. SS&C Technologies Holdings. SS&C, software for financial services and healthcare.
Right, providing the tech stack for front, middle, and back office functions in those industries, accounting, trading, portfolio management, etc.
Performance, fiscal year 2024.
Consistent growth. Revenue up to $5.88 billion. Gross profit, operating income, net income all grew year over year too. Demonstrates stable financial performance. Q1 2025 filed in April.
Growth catalysts, specialization.
Focus on tech-powered solutions for their specific industries. Their integrated tech stack and deep reach provide competitive advantages, client stickiness.
Risks or headwinds mentioned.
Recent stock price weakness, noted in April 2025, down quite a bit month to date then. Their PE of 25.8 considered high versus a direct industry median of 22.6.
So price weakness despite positive momentum, market reevaluating the premium.
Possibly, or just broader market factors at play.
Valuation summary, April 2025.
Price, $80.80. PE, 25.8 premium to direct peers, but below broader IT consulting average. Analyst consensus is strong buy from 10 firms. Average target, $91.33. Decent upside. Range, $75 to $100. Strong support suggests confidence in fundamentals despite recent stock dip.
And finally, Verisk Analytics, VRSK, data analytics risk assessment, mainly insurance.
Primarily insurance, yeah. Property casualty, life reinsurance, but also serves construction, consumer insights, transportation, others.
Performance details.
Not many in these snippets. Q1 2025 filed in May. Growth catalyst is their core strength in specialized data analytics, crucial for clients, especially insurers. Diversification across industries helps too. No specific risks were identified in the snippets.
Valuation, late May 2025.
Price, $314.14. PE 43.21. Significant premium versus data processing industry averages mentioned. PE 22.5, EV/EBITDA 11.8. High expectations priced in for their specialized data niche. Sensitive to slowdowns. No specific analyst consensus data provided.
Okay, wow. That's a lot of companies.
Yeah.
Let's try to synthesize this based on your sources. We started with that challenging macro picture.
Right. Slowing global U.S. growth, tariffs, cautious Fed, cooling labor market. Definite headwinds.
But then we saw strong sector tailwinds for many of these companies.
Exactly. Huge demand for cybersecurity, AI adoption driving growth, cloud shifts, recurring revenue models providing resilience.
And that creates this real tension, especially in valuations, right?
Absolutely. Many of these stocks, Okta, Palo Alto, Broadcom, Palantir, Zscaler, Trade at really high premiums. Pricing in huge amounts of future growth, AI potential, makes them super sensitive.
While others, maybe A10 Networks, Infosys, looked relatively more reasonable on traditional metrics, reflecting maybe different challenges or market views.
Yeah, different profiles, and we saw a real divergence in financial health, too.
Some clearly profitable, strong cash flow SS&C, maybe Cisco, Broadcom showing strong margins.
Others in heavy investment mode, CrowdStrike, Sentinel alone showing losses but positive free cash flow, which is key.
And then some tricky ones. Qualcomm, Zscaler, reported growth but concerning cash flow trends.
Right, raising questions. And Cognite, Palantir valued highly despite being very early on profitability.
So this deep dive really focused on pulling out those key points from your specific sources.
And understanding both that big economic picture described and the nitty-gritty of each company, their catalysts, risks, valuation, context is crucial for making sense of this material you provided.
And just to reiterate, this analysis is purely based on the text you shared. It's absolutely not investment advice. We're just helping you process the information here.
So maybe a final thought to leave you with, based on all this, consider this. Given those challenging macroeconomic winds, the sources describe tariffs, slowing growth, how much of that amazing future growth potential in AI, cloud, cybersecurity is already fully captured in the current, often high valuations of these companies. And if you think about that, where might the unexpected value or perhaps the unexpected risk truly lie within this sector according to this material? Something to ponder.